Japan's government has released growth data for the first quarter of this year, and the numbers show the economy has taken a step back.
Japan's three biggest names in the auto industry announced disappointing numbers for the last quarter of the business year, and they're warning of rough waters ahead.
Rice prices in Japan remain stubbornly high. Consumers are struggling to put food on tables and retailers to put products on shelves at affordable prices.
The government has been trying to fix the problem with limited success.
The Prime Minister of Japan just issued a terrifying warning that sent shockwaves through every major financial capital on Earth. In a desperate emergency address, he compared Japan's current crisis to the economic collapse that obliterated Greece, but this time, the stakes are infinitely higher. Japan isn't just another struggling economy, it's the world's largest creditor and holds more US government debt than any other nation. When Japan's 9 trillion debt mountain, now 260% of their entire GDP, finally collapses, it won't just destroy Japan. It will trigger a global financial apocalypse that makes 2008 look like a minor market hiccup. But what happens when that bedrock begins to crack? How did a country renowned for its economic discipline and long-term planning arrive at this precipice, facing what its own leadership calls an unprecedented crisis? And as the Bank of Japan's multi-decade experiment with near-zero interest rates shows signs of ending, is the world about to discover the true price of Japan's debt bomb? This is not just another line item on a national ledger. It is the largest and most extreme public debt burden in the modern world. To call it a mountain of debt is to understate the scale. It is a financial black hole, with a gross debt to GDP ratio soaring past 263%. Japan's liability is proportionally more than double that of the United States, and dwarfs the level that triggered Greece's infamous meltdown in 2009. For decades, this debt Godzilla was kept dormant, sedated by an unprecedented policy from the Bank of Japan, which now holds more than half of all outstanding government bonds. This radical strategy effectively turned the central bank into the government's primary financier, creating a closed loop that defied economic gravity. But the laws of finance are not easily broken, they are merely postponed. The first tremors of a seismic shift are now being felt as Japan's borrowing costs recently surged to a 20-year high. The very sedative that kept the monster asleep, rock-bottom interest rates, is wearing off. Every tick upward in bond yields adds billions to the government's financing costs, threatening to ignite a vicious cycle of borrowing just to pay interest. The world's most audacious monetary experiment is now facing its day of reckoning, and the consequences are cascading outward. For decades, warnings about Japan's debt were dismissed with a simple fact. The debt was overwhelmingly owned by its own citizens. It was a domestic affair, a closed loop where a nation of diligent savers lent to its own government. This unique structure, where over 90% of government bonds were held internally, created a seemingly stable paradox. The debt Godzilla was on a leash, held by the very people it represented. But that leash is now fraying. The demographic winter Japan has been warned about for a generation has arrived, shrinking the pool of domestic savers needed to absorb the endless supply of new government debt. This is what makes the current moment fundamentally different. The old equilibrium is broken. The Bank of Japan was forced to step in as the buyer of last resort, monetizing the debt on a scale never before seen in a major economy. Now, with inflation finally returning after 30 years of slumber, the central bank is caught in a fatal bind. Raising interest rates to defend the collapsing yen and fight inflation would detonate the fiscal bomb, making interest payments on the national debt spiral out of control. Keeping rates at zero means the yen's value evaporates, impoverishing the nation, and that's the choice that has paralyzed policymakers. The seeds of this crisis were planted over 3 decades ago. When Japan's spectacular asset bubble burst in the early 1990s, it didn't just crater the stock market, it plunged the economy into a deflationary coma that would last a generation. This was the birth of the lost decades. In response, successive governments in Tokyo reached for the only tool they felt they had: massive fiscal stimulus. Year after year, trillions of yen were pumped into public works projects, creating bridges to nowhere and cementing coastlines in a desperate attempt to resuscitate economic growth. Each stimulus package, like the massive 46.1 trillion yen package in 2009, was a bet that the government could spend its way back to prosperity. This strategy became a political and economic addiction. The short-term jolt of government spending was too tempting for politicians to resist, even as the national debt began its relentless climb. Deflation, a persistent monster, devoured any real growth, making the debt burden heavier with each passing year. The government wasn't just borrowing from its future, it was selling it off piece by piece to fund the present. The belief was that Japan's high savings rate could finance this indefinitely, and for a long time that assumption held, masking the slow-motion catastrophe unfolding beneath the surface until the savers themselves began to disappear. The demographic tsunami that economists warned about for decades has finally made landfall. Japan's population is shrinking by over 400,000 people annually, while nearly 30% of its citizens are now over 65. This isn't just a social challenge, it's a fiscal death spiral. The army of savers who once reliably bought government bonds is liquidating their holdings to fund retirement, reversing the flow of capital that kept the debt machine running. Meanwhile, the shrinking workforce means fewer taxpayers to service an ever-growing debt burden. The math is brutal and unforgiving. The Bank of Japan's response has been to double down on its radical experiment, now owning more than 50% of the entire government bond market. This unprecedented monetization has turned the central bank into a financial black hole, absorbing debt at a pace that would make Zimbabwe's hyperinflation architects blush. But the strategy has reached its breaking point. The yen has collapsed to multi-decade lows, making imports crushingly expensive for a nation that imports nearly everything it consumes. Energy costs have skyrocketed, food prices are surging, and the very deflation that justified this policy is finally giving way to the inflation that could destroy it, and the government's ability to service its mountainous debt. The endgame is now crystallizing into three distinct pathways, each more treacherous than the last. First, the soft landing mirage, where the Bank of Japan somehow threads the needle, gradually raising rates while the government simultaneously cuts spending and raises taxes. This scenario requires political courage that has been absent for 3 decades and assumes bond markets will patiently wait while Japan slowly deleverages over 20 to 30 years. The probability of this outcome hovers near zero. Next comes the controlled detonation, a managed default where Japan restructures its debt, likely wiping out pension funds and bank balance sheets in the process. This would trigger a global financial earthquake, given Japan's role as the world's largest creditor nation, holding over $1.1 trillion in U.S. Treasury bonds. Then there's the hyperinflation hellscape, where the Bank of Japan abandons all pretense and prints money to directly fund government operations, Zimbabwe style. The yen would collapse, imports would become unaffordable, and Japan's elderly population would watch their life savings evaporate in real time. Each scenario ends with the same result: the world's third largest economy imploding, taking significant chunks of the global financial system with it, and the clock is ticking faster than policymakers dare admit. Faced with this fiscal Armageddon, Japan's leadership is desperately deploying what economists call the financial repression playbook, a strategy of keeping interest rates artificially low while allowing inflation to slowly erode the real value of debt. It's a stealth default by another name. The Bank of Japan has implemented yield curve control, capping 10-year government bond yields at artificially low levels, essentially forcing savers to subsidize the government's borrowing binge. This policy has turned Japanese banks and pension funds into unwilling accomplices, trapping them in low-yielding government bonds while inflation quietly devours their purchasing power. The government is also betting on a technological miracle, that artificial intelligence and automation can somehow boost productivity, enough to grow the economy out of its debt hole. Massive investments in robotics and digital infrastructure, totaling over 7 trillion yen in recent budgets, represent a Hail Mary pass to reverse decades of stagnation. But this strategy requires time Japan doesn't have and assumes that technology can overcome the fundamental mathematics of compound interest. The most telling sign of desperation is the government's recent push to encourage citizens to invest in risky assets through tax-advantaged accounts, essentially asking its own people to gamble their way out of a crisis, while the house always wins.